So thank you, Georgia. And this is joint work with Michele Ciampi, Malik Magdon-Ismail, Rafail Ostrovsky, and Vassilis Zikas. Zikas is also my PhD advisor. And we have this construction to prevent front running in digital assets trading. Uh, so speaking of trading, traditionally crypto exchanges have been order book based. And what I mean when I say order book is that you have an exchange and you have a bunch of people who want to sell an asset. So they have their demands or asks. These are the prices that they demand for selling these assets. We also have a bunch of buyers who have their bids or offers. These are the prices that they are willing to buy these assets at. And they talk to the exchange. The exchange maintains an order book. So what this order book is essentially an asks list and a bids list. And it performs a matching between them. And a trade is executed whenever we get a matching. Uh, so the traditional crypto exchanges like Binance and Bittrex, they are all order book based, right? The problem here is that if you have no matching, there cannot be any trades, right? And in fact, the matching algorithm itself may have some problems, but we leave that out for now. And this is also more susceptible to rapid price fluctuations because the prices are directly being specified by the uh, actors that are interacting with the system, right? The other type of an exchange is what we call a market maker, and actually Kaihua briefly touched on it with his automated market makers section. So now we still have an exchange, but this exchange has an inventory and it is buying into this inventory. It's selling from this inventory. And since it is buying and selling assets itself, it gets to set the prices. And the prices are set through this algorithm called MM algorithm. I mean, we could call it something else, but it has an algorithm that's deterministic and it is used to set these bid ask prices. So again, we have a bunch of traders that communicate with this exchange and they get their uh, assets or they sell their assets. Newer market makers like Uniswap, Kyber, that Kaihawa mentioned, Bancor, Curve, Ether Delta, there are a bunch of these actually. These are automated market makers. Most of these live on Ethereum as smart contracts. And there is a problem here. So see these bunch of traders, I hope you can see my mouse pointer. When they talk to the exchange knows exactly what these traders are and what their trades are. So he has more information than these traders might have, which gives him an advantage, right? And he has the potential to reorder these trades in a way that benefits him, or maybe benefits one of these guys. We don't know, but he does have an advantage, and this is an unfair advantage. So the problem is that market maker can now reorder trades. This is precisely the front running problem. And there is evidence that it happens both in traditional stock markets. There is this book called Flash Boys by Michael Lewis. And in cryptocurrency markets, the paper by it's Philip Diane from IEEE Oakland 2020, uh, appropriately called Flash Boys 2. So these guys present evidence that these attacks happen all the time. Uh, so, and this is a long-standing problem. In fact, up until recently, it wasn't solved at all. Recently, there is this paper by Baum et al. Called P2DEX that solves it, but it needs a trust assumption. So also, they are not implementing a market maker. Their exchange is order book based, and they are essentially implementing the exchange as an MPC. So the assumption is that if the servers which are running the exchange MPC protocol, if those servers are honest, then the trade reordering cannot happen, right? So this is where we come in. We have this construction that we call FairMM, and our primary contribution is front-running resilience. We implement it through a bunch of building blocks, which I'll go over in a minute, segmented protocols, which are used internally in a verifiable market maker. And we use cryptographic primitives to force trade sequentialization. And our system has very high throughput, at least higher than the other state-of-the-art solutions that we have looked at. Oops, sorry. Right, so for the verifiable market maker, we employ a monopolistic profit-seeking market maker. So let's briefly look at it before we look at our building blocks. So specifically, we are instantiating this profit-seeking market maker by Sanmay Das and Malik Magdon-Ismail, DMI08. The model is that the market is modeled as a process in which a single market maker exists. Environment oblivious means that this market maker has no idea of the true value of the assets, except maybe a mile prior. Uh, it discovers the value of the assets through trading. So the traders essentially give it signals towards the true value of the asset, right? So the goal of such a market maker is long-term profit, and there is research that shows that this market maker actually provides better liquidity than a market maker that is altruistic, that does not want any profit, right? So back to the building blocks. So the first abstraction that we have is a 3-round asset swap protocol. We call it Sigma trade protocol because it has 3 rounds like the classical Sigma protocols. So the buyer or customer speaks first to the seller. Seller in our case is a market maker, but it could be any other vendor. It sends a trade request. In response, it gets some information about the trade, prices or some, and additionally some more information. And if the prices are favorable, the trader or the customer makes a trading decision and signs a trade, sends it to the seller, right? So the seller at this point can make the trade effective. This protocol, these 3 rounds happens off chain. There is an initial setup though. So this protocol is executed many times after an initial setup, right? The natural question here is that what if after round 3, the buyer goes away? How do we ensure the seller or the market maker gets its payment? So that's where the setup comes in. So even before running this Sigma trade protocol, buyer locks sufficient money in some smart contract SC, and as part of round 3, he sends appropriate signatures, which the seller can then use to invoke SC to get its payment. And SC is implemented so that it makes sure that a market maker has already paid before paying him for the assets, right? And SC, the smart contract, is used multiple times. So the cost of the setup amortizes over time, right? So now, how do we achieve fair ordering from this? So one way to do this is that, say we have a queue of buyers. Buyer I is at the front of the queue right now. So he speaks to the seller, sends a request, gets a ticket and a price. He prepares a trade object. Importantly, it contains the amount or the quantity that it wants to buy or sell, the type of trade, buy or sell, and sends it over. So at this point, the seller finalizes the trade using this trade I object and goes to the next trader, right? The next buyer, right? So this gives rise to trading history, and this trading history is public. So and we know that market making algorithm, the MM algorithm, is deterministic and public. So everybody can just look at this history and verify that no manipulation has happened, right? But there is a problem. So market, this trading history can still be manipulated by the market maker, right? Looking at this chain, we can verify that price manipulation that hasn't happened. But what if the history has been rewritten? So to make sure the price adjustment looks legit. So for that, we turn to another trick that we have in such cases. And at the very first round, the trader sends an identifier. In this case, we can think of it as a public key. And the market maker or the seller has a hash chain. So he has a hash chain header. He concatenates this header with the identifier of the trader, computes the new hash, and as part of the ticket, he sends this hash chain header and the price and any other information that the buyer needs to the buyer. Now the buyer prepares the trade object as before, sends it over, and the trade object itself becomes part of this hash chain, right? Good. So, and at that point, we go to the next buyer. So this gives rise to a hash chain. So this trade history is now, if the hashing function is collision resistant and uh, uh, so the market maker is polytime, he has no way to rewrite this, right? So at this point, we seem to be pretty much done. We know MM algorithm, so we can make sure the price manipulation hasn't happened. We know that this trade history is a hash chain, so we can detect if it has been manipulated, if there are inconsistent hashes. So we can detect misbehavior, right? But the problem is we can only detect it. How do we prevent it? And this is where we can either get ditch lightweight cryptography and start thinking about heavyweight, expensive cryptographic primitives like MPC, or we can combine it with some reasonable game theoretic argument. And that's the approach that we took. So as part of the setup, even before the very first trade has happened, the market maker locks some collateral in a smart contract, and traders can complain to this smart contract if they detect misbehavior. In fact, they are incentivized to report misbehavior through a reward, right? And if the smart contract detects misbehavior, uh, collateral is destroyed, uh, uh, of course, minus the reward. Therefore, the market maker, the rational market maker, has no incentive to cheat because he or she does not want to lose the collateral, right? So this is, like I said before, combining cryptography with game theory does provide us a defense, and it's still cheaper in terms of computational resources, right? This is pretty much the overview of our construction. You can look for the details in the paper itself. So let's now look at the performance. And to this end, realize that at the very core of our protocol is this Sigma trade protocol. And after the market maker speaks to the trader in the second round, the trader can go away. So in the realization of this protocol, we have a timeout here, which is set to 100 milliseconds. This is the typical round trip time of the network. So, but this is variable. This can be set to some other parameter, right? The point is that market maker will not wait indefinitely for round 3. After the timeout expires, the market maker would assume that the trader does not want to trade and move on. And depending on the response in the third round, the computation after the third round either takes 50 milliseconds in our setting or 300 milliseconds. If the message is trade, that is expensive to compute on market makers end, so that takes around 300 milliseconds. Otherwise, it's 50 milliseconds. So this is at the very heart of the protocol, and this is going to affect the performance. So now let's look at the typical denial of service attack. Along the x-axis, we have the various timeout parameters. The timeout parameter that I just talked about, you can see that previous slide over here. It starts at 100, which is the minimum that we decided on, because this is the typical round trip time. Any lower than this, and we would stop dropping the honest traders who just couldn't respond in time. Maybe their network was slow or something. So the y-axis is the throughput in terms of trade per second. And in case of zero corruptions, this green bar, you see that it's slightly over 200 trades per minute. And this is very good. The P2 DEX construction that has an MPC in it achieves slightly less than 100 trades per minute. So we are already double than them in the realistic WAN setting. And if we increase corruption, at higher timeouts, the throughput starts going down. At low timeouts, it seems to be as if there is an anomaly, right? The throughput is actually going up. So this is not an anomaly, because remember, if the last message was trade, that would be expensive for the market maker to compute. And in our experiments, the honest traders always say trade. They never say no trade. So the corrupt traders who go away, the market maker assumes that they are not willing to trade, and he actually ends up computing the cheaper message in the last round of 50 ms. So as long as this timeout is less than the time that it takes for the market maker to compute the expensive message, if you increase corruption, the throughput would actually go up. However, as soon as this timeout goes higher, then the throughput starts suffering. In real life setting, many honest traders would also probably choose no trade if, for example, the prices are not favorable. So this 200 trades per minute should really be thought of as the lower bound. Okay. So in typical denial of service attack, we are very competitive. This is actually not the worst that can be. This is not the worst way that someone can attack our system. There is actually a better attack. So now we have a very determined adversary who wants to pay to slow the system down. So what this adversary does is that it does not go away after the first round. No. After the second round, once it has heard from the market maker, it has a ticket now. It waits until just after the timeout, until just before the timeout, and then it immediately says trade. So it is paying. It says I'm trading, but it waits until just before the timeout to make sure that it is slowing the system down. This is not a rational adversary, but even in this case, if you stick to the realistic and recommended timeout parameters of about 100, you would not see any change. Look, notice that this x-axis start at 200, which is because if we had started at 100, we would see exactly this pattern here. The reason is at 100, the adversary has no budget to wait for. The adversary needs to wait till just before the timeout. So at 200, the adversary can probably wait about 100 milliseconds plus minus some noise and then respond. So if you stick to low timeouts, you still get at least 150 at least 150 trades per minute, which is extremely competitive. So now, for the sake of comparison, we look at how our system compares with Uniswap. And briefly, an overview of Uniswap is that it's, in terms of market cap, the largest automated market maker. It's implemented as a bunch of contracts on Ethereum blockchain. You can trade Ethereum tokens through Uniswap, and trades are executed through calls to the router contract. Trade cost is variable because it depends on the trade itself. And the highest daily volume on Uniswap uh, that we noticed, this is correct as of 11th April, so maybe it has changed, but the one that we noticed was 199K transactions in 24 hours. That translates roughly to 138 trades per minute. So, and remember, Uniswap and other such market makers that live on the blockchain, due to the inherent public nature of the blockchain, cannot have any front running resilience. In fact, they have a couple of other problems as well. So let's look at the comparison. Like I just said, Uniswap and other such distributed market makers cannot have front running resilience because the order of the trades is decided by the market, by the miners. So miners can choose to favor the transactions that they like for some reason. Maybe the transactions that are paying them the higher transaction fees, or the transactions that belong to their friends or something. So because of this market, because of this minor influence, they and the public nature of the blockchain, they cannot have front running resilience. Uniswap doesn't have it. We have it. And precisely because of this,
I just wanted to mention, if you can maybe wrap up in 2-3 minutes, then we take some, there are some questions from the audience.
Sure. This is pretty much the second last slide. So, precisely because of the miners' influence, they rather encourage this behavior called gas auctions that Tim mentioned in his talk earlier in a different context. So the thing is that if I want to front run, I need to get my transaction in sooner. The way I get it in sooner is that I pay a higher gas price. So competing traders start interacting in this behavior in which they are gradually increasing the gas prices. And the problem is that these gas price auctions raise gas prices for everyone. So not just the traders on Uniswap. So this is something that is not ideal. If we can avoid it, we should avoid it. We avoid it because the ordering of the trade is decided much before the corresponding trades hit the blockchain. The miners can include these trades in any order. The pricing was decided offline before these trades appeared on the blockchain. So we are not susceptible to this. Concretely, in terms of numbers, the time that you submit your trade to the time that it gets either confirmed or rejected, in our case, it's about 0.3 seconds. This is on a consumer laptop. If we were using a high-end server, it would be even lower. On Uniswap, it's kind of hard to estimate, but even the fast transaction confirmation that not confirmation inclusion that Etherscan shows take about 30 seconds. So it should be reasonable to say that a trade takes at least about 15 seconds on Uniswap. Our trade cost is constant. We cost 101K gas. On Uniswap, we observed over 1 million transactions and averaged them. The average was 141K. The maximum was about 1300K. And max throughput based on average trade cost is, of course, higher in our setting because we cost less. Right. So that's the comparison with Uniswap. We are still actively working on this project, and a few directions that we are working on are improving the throughput. Even though our throughput is very competitive, we still realize that it could become a bottleneck, potentially become a bottleneck in future. So we want to improve it. Currently, our MM works with Ethereum blockchain only. We want to do cross-chain trades. And right now, the only way outside users interact with our system is as traders. It might be interesting to let them be liquidity providers as well. So those are the areas that we are working on. Thank you very much for listening to me, and I would be happy to take questions.